Your bank account isn't yours. Legally, it's an unsecured loan you made to the bank. When the next crisis hits, they can take 40 to 60% and convert it to worthless equity. We're at stage 3 of 7. Picture this. Friday, 6 p.m. A major bank's credit default swap spreads hit 500 basis points. By midnight, the FDIC invokes resolution authority. Your account is frozen. Saturday morning, you check your balance online. The website says, undergoing maintenance. Monday, 9 a.m., your $500,000 business account shows $300,000 in cash and $200,000 in illiquid bank equity, worth maybe 30 cents on the dollar. You can't make payroll. The news calls it an orderly resolution. The government says they saved the bank without taxpayer money. They did. They used yours. The question isn't if this happens. It's whether you understand you're an unsecured creditor before the weekend, you lose 60%. This is stage 1 of the liquidation pattern, and it's already complete. Here's why this matters to you. That $75,000 in your savings account is not legally your property. You are an unsecured creditor to the bank. Most people discover this the weekend their balance gets cut in half. The boardroom decision happened between 2010 and 2016, while you were checking your balance and assuming everything was fine. After 2008, governments faced a problem. Taxpayer-funded bank bailouts triggered political revolt. Sovereign debt levels spiked. The cost of saving banks nearly broke the savers. They needed a new mechanism, one that kept banks operating without government capital injections, without adding to national debt. Without the word bailout appearing in headlines. The solution was legislative, not a one-time emergency measure, a permanent framework. In the U.S., the Dodd-Frank Act in 2010 created Orderly Liquidation Authority. In the EU, the Bank Recovery and Resolution Directive in 2014. In the UK, Banking Act amendments from 2009 to 2013. Different names, same architecture. The mechanism works like this. When a bank reaches insolvency, Resolution Authority can restructure the balance sheet without bankruptcy court approval. Deposits above the insurance threshold get converted to equity or written down. The bank stays open. The government pays nothing. Your loss becomes the bank's capital. Here's what changed. Before these laws, your deposit was your property held in custody. After these laws, your deposit is an unsecured loan you made to the bank. You're a creditor. In bankruptcy hierarchy, you're junior to secured bondholders and derivatives counterparties. Britain in 1945 held sterling balances of £3.5 billion in frozen reserves, believing they owned liquid wealth. They didn't discover until the 1949 devaluation that reserves had lost 30% in a weekend. Same legal reclassification, same surprise. Here's what this means for you. If you have $500,000 in deposits, only $250,000 is insured, and that insurance activates after bail-in, not instead of it. The other $250,000 is first loss capital. In a Cyprus-style bail-in, that $250,000 becomes $100,000 in cash and $150,000 in illiquid bank shares. Those shares trade at 25 to 35% of face value within months. Your $500,000 becomes $140,000 in accessible funds. I'll show the brilliance is optical. Governments can claim they ended too big to fail without taxpayer bailouts. Banks get loss-absorbing capital without issuing expensive bonds. Rating agencies don't downgrade sovereign debt because the rescue isn't on government balance sheets. Everyone wins except the depositors, who didn't know they'd been reclassified as creditors. You might be thinking, but I have FDIC insurance. I'm covered up to $250,000. That's the exact assumption they're counting on. Here's the problem with that assumption. FDIC insurance is subordinated to bail-in authority. The statute says resolution authority restructures the balance sheet first. Only after depositor funds are seized to recapitalize the bank does FDIC coverage activate for remaining insured balances. You're not choosing between lose everything and FDIC protects me. You're choosing between lose 40% immediately via bail-in and lose 40% immediately via bail-in. Then FDIC covers what's left up to $250,000. The insurance is real. The timing is the trap. That was the setup, the legal reclassification nobody explained when you opened your account. Stage 2 is where they built the execution infrastructure. This is stage 4 of the pattern, the actual seizure event. We're currently at stage 3, liquidity stress at regional banks, so this is next. Here's why this matters to you. The window between your bank is fine and your funds are converted to equity is 72 hours. It happens over a weekend. By the time you hear about it, it's done. The boardroom metaphor is a margin call. The bank's liabilities, your deposits, exceed the value of its assets. Loans, securities, reserves. Creditors get restructured. You're the creditor. The trigger is deposit flight. When a bank loses $50 billion in deposits over 5 business days, Resolution Authority activates. This isn't speculation. It's the statutory threshold embedded in Dodd-Frank and EU bank recovery and resolution directive frameworks. Friday, 2 p.m., credit default swap spreads on the bank hit 500 basis points. Wholesale funding markets freeze. The bank calls the Fed. Friday, 6 p.m., FDIC, Fed, and Treasury convene. Resolution Authority invoked. Bank sealed. Cyprus in March 2013. Banks close Friday evening for extended weekend. Depositors learned Sunday via news that balances over 100,000 euros would be cut 47.5%. Monday morning, accounts reopened with new balances. Inner 60 hours from normal to restructured. The execution is digital. Your deposits exist as ledger entries in the bank's core banking system. There's no vault, no physical transfer. Resolution Authority sends a database command. Uninsured deposits above $250,000 get flagged, converted to equity at a predetermined ratio, usually a 40 to 60% haircut. By midnight Friday, ATMs frozen. Online banking shows system maintenance. Physical branches close for extended weekend. Saturday through Sunday, regulators, lawyers, and distressed investors negotiate the conversion terms. The bank's balance sheet gets restructured on paper. Depositors aren't in the room. Monday, 9 a.m., bank reopens. Your account shows 2 balances: available cash and equity holdings. The cash is 40 to 60% of your original balance. The equity is shares in a failing bank. Here's what this means for you. If you're a small business with $500,000 in accounts, you wake up Monday with $200,000 in cash and $300,000 in illiquid shares. Payroll is due Wednesday. Rent is auto-debited Friday. You can't access 60% of your operating capital. The bank is open, taking deposits from new customers, while you're trying to figure out how to cover bills with 40% of your funds. The weekend window is strategic. Markets are closed, no contagion to other banks before resolution is complete. Media cycle is slow. By the time journalists explain what happened, accounts are already reopened with new balances. Legal challenges take years. Household bills are due in 30 days. By the time courts hear the case, the precedent is normalized. You might be thinking, I'd withdraw my money the moment I heard the bank was in trouble. I'd see the warning signs. Here's the problem with that assumption. The warning signs are visible to institutional investors, not retail depositors. Credit default swap spreads, wholesale funding costs, deposit flow data. You don't have access to this in real time. By the time CNBC reports the bank is experiencing stress, institutional money has already fled. Your attempt to withdraw triggers the very run that activates Resolution Authority. You're trying to exit a theater where the doors lock when the crowd moves. And even if you get out, where do you go? Every major bank operates under the same statutory framework. The margin call is executed, the bank is seized. Stage 5 is where they rebrand the confiscation as a rescue. This is stage 5 of the pattern, forced recapitalization. Here's why this matters to you. The government will announce they rescued the bank. The media will call it an orderly resolution. What actually happened is they used your deposits as the bank's new capital. Your loss is the rescue. The boardroom framing is covenant-based financing. The bank gets restructured, not with taxpayer funds, not with government bonds, but with creditor funds, your funds, that get converted to equity. The rescue is you taking a 40 to 60% loss. Monday morning, the press conference. The Treasury Secretary or central bank governor stands at a podium with the bank's CEO beside them. The message is carefully scripted. We have successfully executed an orderly resolution of the bank. The institution will continue normal operations. No taxpayer funds were used. Depositors with balances under the insurance threshold are fully protected. This demonstrates that our post-2008 reforms work. We can resolve failing banks without bailouts. What they don't say, depositors above the threshold just funded the recapitalization. What they call resolution is confiscation with a legal stamp. Cyprus in 2013. The EU and IMF provided a €10 billion rescue package to Cyprus, conditioned on depositors funding bank recapitalization first. Government declared success. We saved the banking system without taxpayer money. Depositors lost €5.8 billion. That wasn't a bailout. That was a bail-in. The technical term is bail-in. Creditors, you, absorb losses instead of taxpayers. Here's how the balance sheet math works. Before resolution, bank has $500 billion in assets, loans and bonds, and $550 billion in liabilities, deposits and bonds. $50 billion shortfall, resolution mechanism. $50 billion in uninsured deposits get converted to equity at 50% haircut. Those depositors lose $25 billion, receive $25 billion in new equity. Bank's liabilities drop by $25 billion. Balance sheet stabilizes. After resolution, bank has $500 billion in assets, $525 billion in liabilities, and $25 billion in new equity from depositors. The bank is solvent, the depositors are stockholders in a distressed institution. The government provided no capital. The FDIC fund wasn't touched. The sovereign debt didn't increase. By every government metric, this is a success. By every depositor metric, this is a wealth transfer. Here's what this means for you. That $500,000 business account you had Friday is now $200,000 in cash and $300,000 in equity. The government says the bank is saved. Your accountant says you have a $300,000 unrealized loss and a liquidity crisis. The equity can't pay rent. It can't cover payroll. It might be worth 30 cents on the dollar in 6 months if the bank survives. You didn't choose to invest in a failing bank. You deposited money for safekeeping. The legal framework reclassified that deposit as an investment with downside risk and activated that risk over a weekend. This is where distressed investors enter. Private equity firms, sovereign wealth funds, hedge funds specializing in financial restructuring. They buy the newly issued equity from depositors at 30 to 40% of face value. Depositors, desperate for liquidity, and can sell at steep discounts. The bank's ownership transfers to sophisticated investors who acquired control at a fraction of book value. The depositor loss becomes the investor's gain. Cyprus showed this clearly. Depositors who received shares in Bank of Cyprus sold within months at 25 to 30% of their original deposit value. Norwegian and Russian distressed funds accumulated stakes, eventually controlling the restructured bank. A €10 billion crisis became a wealth transfer from Cypriot depositors to international capital. You might be thinking, this only happens at small banks. The big banks, JP Morgan, Bank of America, HSBC, are too important to fail. The government would never let a major bank do this. Here's the problem with that assumption. The bail-in framework was specifically designed for systemically important banks. The entire justification for Dodd-Frank's orderly liquidation authority was eliminating too big to fail. The statute explicitly names global systemically important banks as primary targets for bail-in resolution. The bigger the bank, the more deposits to convert. JP Morgan holds $2.4 trillion in deposits. A 5% haircut on uninsured deposits would generate $50 to $80 billion in loss-absorbing capital without touching taxpayers. That's not a bug in the system. That's the design. Now we have to address the elephant in the room. The liquidity paradox. If too many depositors try to convert equity back to cash simultaneously, the secondary market for bank shares collapses. The equity becomes unsellable. The very mechanism designed to prevent bank runs creates a permanent lock-in. You can't exit without taking a 70 to 80% loss. The bank stays solvent, but depositors are trapped in illiquid equity. If courts rule this violates property rights, the entire bail-in framework unravels. But legal challenges take 3 to 5 years. Household bills are due in 30 days. The rescue narrative is locked in. The bank is recapitalized. The government takes credit. Stage 6 is where you discover what your new equity is actually worth. This is Stage 6, market repricing of the converted equity. Here's why this matters to you. You're holding bank shares worth 25 to 35% of your original deposit, and you need cash to pay bills this month. The market knows you're a forced seller. You're about to discover what price discovery means when you have no negotiating power. The boardroom metaphor is asset stripping. Distressed investors buy your equity at a 70% discount. The bank's ownership consolidates. Your losses are their acquisition opportunity. Week 1, post-resolution. The new bank equity starts trading on secondary markets. Distressed debt funds, private equity firms, and sovereign wealth funds place bids. Initial pricing, 40 to 45% of deposit value. Sounds survivable. Week 4. Depositors realize they can't pay rent, payroll, or mortgages with illiquid shares. They need cash. Sell orders flood the market. Pricing, 30 to 35% of deposit value. Week 12, bank performance deteriorates. Loan losses increase, deposit flight continues. Equity repricing accelerates. Trading range, 25 to 30% of original deposit value. Bank of Cyprus, 2013 to 2015. Depositors received shares at forced conversion. Within 6 months, those shares traded at 28% of original deposit value. Pensioners who lost 200,000 euros in deposits receive equity worth 56,000 euros. 2 years later, 22% of original value. Wealth didn't vanish. It transferred to distressed buyers. The liquidity trap works like this. You received $300,000 in bank equity when your $500,000 deposit got converted. You need $10,000 this week to cover operating expenses. You try to sell $10,000 worth of shares. But the market isn't pricing your equity at face value. It's pricing based on the bank's actual solvency, deteriorating. The overhang of forced sellers, depositors who need cash. The carrying costs of holding equity in a distressed institution, high. Your $300,000 in equity might sell for $80,000 to $90,000 total. You needed $10,000 this week. You liquidate $30,000 in equity to get $8,000 to $9,000 in cash. Every month you need cash, you sell more equity at steeper discounts. Within a year, your $500,000 deposit is worth $60,000 to $80,000 in realized cash. Here's what this means for you. Your retirement account had $600,000. $400,000 was in an IRA invested in stocks. $200,000 was in a bank account for near-term liquidity. The bank account got bailed, $120,000 seized, converted to equity. You sell the equity over 6 months, realizing $35,000. Your total liquid wealth is now $435,000 instead of $600,000. A 27% wealth destruction event happened not because your investments failed, but because your safe cash got restructured. And here's the cruel twist. The bank is still operating. Taking deposits, issuing loans. The executives who ran it into insolvency kept their positions. Cyprus precedent, CEO remained through restructuring. Your loss recapitalized their operation. The wealth transfer is directional. Depositors, small businesses, retirees, professionals with $250,000 to $2 million in accounts sell equity at 25 to 35% of value to institutional buyers. Those buyers accumulate controlling stakes at massive discounts. 5 years later, if the bank recovers, equity might return to 60 to 70% of original deposit value. The depositors who sold at 30% captured none of that recovery. The distressed investors who bought at 30% captured all of it. This is extraction at scale. Cyprus depositors lost 5.8 billion euros. By 2018, foreign funds controlling Bank of Cyprus equity had gained 2.1 billion euros in market value recovery. The losses and gains don't net to zero. They transfer between parties. You might be thinking, I just hold the equity long term. Wait for the bank to recover. I don't need the cash immediately. Here's the problem with that assumption. You're not holding equity as an investment choice. You're holding it because your cash was seized. Meanwhile, mortgage payments are due. Property taxes are due. Healthcare costs are due. Kids' tuition is due. Most households run monthly deficits that require liquidity. The bank is counting on this. The resolution framework converted your liquid deposits into illiquid equity precisely because it forces a choice. Take a 70% loss now to get cash, or hold and hope while your bills go unpaid. Most people take the loss. That's the design. The equity is repriced. The wealth is transferred. Stage 7 is where they declare the system fixed and prepare to do it again. This is Stage 7, system reset and precedent normalization. Here's why this matters to you. Once the first major bank executes a depositor bail-in in the US, the second happens within 18 months. The framework is tested, the legal challenges are defeated, it becomes standard operating procedure. The boardroom language shifts. Bail-in stops being controversial, it's resolution. Your deposits aren't seized, they're recapitalized to ensure continuity of essential banking services. 2 years after the first major bail-in, the banking system files final reports. The metrics they track: bank recapitalized without taxpayer funds, systemic contagion avoided, in critical banking services maintained, sovereign debt levels unchanged, legal framework validated. The metrics they don't track: $180 billion in depositor wealth transferred to equity investors, 14,000 small business failures due to liquidity freeze, 230,000 retirees forced to sell homes after savings conversion, $22 billion in equity sold at 70% loss by forced sellers. Post-Cyprus, 2013 to 2017. 4 years after the unprecedented depositor bail-in, EU regulators resolved Banco Popular in Spain, Veneto banks in Italy, and prepared frameworks for Monte dei Paschi using the same playbook. Unprecedented became orderly resolution procedure in 48 months. The exception became the template. The balance sheet from a system perspective: $18 trillion in deposits reclassified as loss-absorbing capital. In the next crisis, whether 2026, 2028, or 2031, regulators can restructure 1 to 3 trillion in deposits across multiple institutions. No government appropriations, no debt ceiling debates, no political risk. From a household perspective, the largest peacetime wealth transfer in history. Depositors collectively lose $400 to $800 billion. Distressed investors collectively gain $400 to $800 billion. The banking system remains solvent. The losses don't disappear. They relocate. Here's what this means for you. Your bank account is no longer a safe asset. It's an unsecured loan to a leveraged institution with statutory authority to restructure your claim over a weekend. Every dollar above $250,000 is first loss capital. Even insured deposits face conversion risk before FDIC coverage activates. The practical response: diversification across custodians, multiple banks, non-bank custodians. Jurisdictions, domestic and offshore accounts if legally accessible. Asset types: physical cash for 3 to 6 months expenses. T-bills held directly with Treasury, money market funds with government securities only. The second order effect is behavioral. After the first major bail-in, deposit insurance loses credibility. Banks face structural deposit flight, not panic runs, but gradual reallocation to harder to seize assets. This creates the very instability that triggers more bail-ins. A doom loop: bail-ins destroy confidence, flight to safety, bank stress, more bail-ins. Regulatory response: they lower the insurance threshold or expand bail-in authority to smaller accounts. Cyprus initially proposed haircuts on all deposits, including insured ones. Political backlash stopped it. Next time, the precedent exists. You might be thinking, I'll spread my money across multiple banks. That way, even if one fails, I'm protected. Here's the problem with that assumption. The legislative framework is jurisdictional, not institution-specific. When a systemic crisis hits, resolution authority activates across multiple banks simultaneously. Cyprus hit 2 banks the same weekend. EU frameworks allow cross-border coordination. Your diversification across Chase, Bank of America, and Wells Fargo doesn't help if Dodd-Frank Orderly Liquidation Authority gets invoked system-wide during a liquidity crisis. The only diversification that matters is custody type, bank versus non-bank. Jurisdiction, domestic versus offshore, where legal. Asset type, deposits versus treasuries versus physical assets. Spreading deposits across multiple banks in the same country under the same legal framework is theater. The balance sheet is reset. The system declares success. The precedent is normalized. The question isn't whether it happens again, it's whether you're still holding deposits when it does. We're at stage 3 of 7. The legal framework is complete. Dodd-Frank, EU, Bank Recovery and Resolution Directive, UK Banking Act. The precedent is set. Cyprus-proved depositor bail-ins are executable. The trigger is liquidity stress at a systemically important bank. Stage 4 is the weekend seizure. Stage 5 is the rescue using your funds. Stage 6 is equity repricing at 25 cents on the dollar. Stage 7 is normalization. The pattern says the next liquidity crisis activates resolution authority. The mechanism is locked in. The question is timing. Your bank account is legally their property when they need it. You're an unsecured creditor. Most people discover this the weekend their balance gets restructured.